Many investors claim that to learn about investing, it's enough to read Buffett's letters to shareholders. If you can understand them, you don't need other books. If not, other books won't help. In the business world, Buffett's letters to shareholders hold a unique status, often hailed as the Bible of investing. In his shareholder letter for 1977, Warren Buffett once again delivered a stellar report card. Operating earnings hit a new high of $21.9 million, and return on equity, ROE, reached an impressive 19%. But in this letter, he first tells shareholders not to focus too much on earnings per share, EPS, growth, as ROE is the true standard for measuring management's performance. The core value of the letter is that Buffett introduces his famous tailwinds versus headwinds theory for the first time. Using this brilliant analogy, he sharply contrasts the tailwind of the insurance business with the headwind of the textile business, revealing that choosing the right boat to be in is far more important than how hard you row. To prove the power of a tailwind, he disclosed a massive $74 million in unrealized gains in the stock portfolio by year-end and UC's Candies as an example, showing how its pre-tax profits grew from $4.2 million to $12.6 million in a few years with little additional capital. In this video, we'll take you deep inside this letter, which is full of golden quotes, to learn Buffett's great business wisdom of tailwinds and headwinds, and his true standard for measuring weather management is excellent. Here is the full text of Warren Buffett's 1977 letter to shareholders. To the stockholders of Berkshire Hathaway Incorporated. Operating earnings in 1977 of $21,904,000, or $22.54 per share, were moderately better than anticipated a year ago. Of these earnings, $1.43 per share resulted from substantial realized capital gains by blue-chip stamps, which, to the extent of our proportional interest in that company, are included in our operating earnings figure. Capital gains or losses realized directly by Berkshire Hathaway Incorporated or its insurance subsidiaries are not included in our calculation of operating earnings. While too much attention should not be paid to the figure for any single year, over the longer term, the record regarding aggregate capital gains or losses obviously is of significance. Textile Operations came in well below forecast, while the results of the Illinois National Bank, as well as the operating earnings attributable to our equity interest in blue-chip stamps, were about as anticipated. However, Insurance Operations, led again by the truly outstanding results of Phil Leish's managerial group at National Indemnity Company, were even better than our optimistic expectations. Most companies define record earnings as a new high in earnings per share. Since businesses customarily add from year to their equity base, we find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. Except for special cases, for example, companies with unusual debt-equity ratios or those with important assets carried at unrealistic balance sheet values. We believe a more appropriate measure of managerial economic performance to be return on equity capital. In 1977, our operating earnings on beginning equity capital amounted to 19%, slightly better than last year, and above both our own long-term average and that of American industry in aggregate. But while our operating earnings per share were up 37% from the year before, our beginning capital was up 24%, making the gain in earnings per share considerably less impressive than it might appear at first glance. We expect difficulty in matching our 1977 rate of return during the forthcoming year. Beginning equity capital is up 23% from a year ago, and we expect the trend of insurance underwriting profit margins to turn down well before the end of the year. Nevertheless, we expect a reasonably good year, and our present estimate, subject to the usual caveats regarding the frailties of forecasts, is that operating earnings will improve somewhat on a per-share basis during 1978. Textile Operations. The textile business again had a very poor year in 1977. We have mistakenly predicted better results in each of the last 2 years. This may say something about our forecasting abilities, the nature of the textile industry, or both. Despite strenuous efforts, problems in marketing and manufacturing have persisted. Many difficulties experienced in the marketing area are due primarily to industry conditions, but some of the problems have been of our own making. A few shareholders have questioned the wisdom of remaining in the textile business, which, over the longer term, is unlikely to produce returns on capital comparable to those available in many other businesses. Our reasons are several. 1. Our mills in both New Bedford and Manchester are among the largest employers in each town, utilizing a labor force of high average age possessing relatively non-transferable skills. Our workers and unions have exhibited unusual understanding and effort in cooperating with management to achieve a cost structure and product mix which might allow us to maintain a viable operation. 2. Management also has been energetic and straightforward in its approach to our textile problems. In particular, Ken Chase's efforts after the change in corporate control took place in 1965 generated capital from the textile division needed to finance the acquisition and expansion of our profitable insurance operation. 3. With hard work and some imagination regarding manufacturing and marketing configurations, it seems reasonable that at least modest profits in the textile division can be achieved in the future. Insurance investments. During the past 2 years, insurance investments at cost, excluding the investment in our affiliate Blue Chip Stamps, have grown from $134.6 million to $252.8 million. Growth in insurance reserves, produced by our large gain in premium volume plus retained earnings, have accounted for this increase in marketable securities. In turn, net investment income of the insurance group has improved from $8.4 million pre-tax in 1975 to $12.3 million pre-tax in 1977. In addition to this income from dividends and interest, we realized capital gains of $6.9 million before tax, about 1/4 from bonds and the balance from stocks. Our unrealized gain in stocks at year-end 1977 was approximately $74 million, but this figure, like any other figure of single date, we had an unrealized loss of $17 million at the end of 1974, should not be taken too seriously. Most of our large stock positions are going to be held for many years, and the scorecard on our investment decisions will be provided by business results over that period, and not by prices on any given day. Just as it would be foolish to focus unduly on short-term prospects when acquiring an entire company, we think it equally unsound to become mesmerized by prospective near-term earnings or recent trends in earnings when purchasing small pieces of a company, i.e., marketable common stocks. A little digression illustrating this point may be interesting. Berkshire Fine Spinning Associates and Hathaway Manufacturing were merged in 1955 to form Berkshire Hathaway Incorporated. In 1948, on a pro forma combined basis, they had earnings after tax of almost $18 million and employed 10,000 people at a dozen large mills throughout New England. In the business world of that period, they were an economic powerhouse. For example, in that same year, earnings of IBM were $28 million. Now, $2.7 billion. Safeway stores, $10 million. Minnesota Mining, $13 million. And Time Incorporated, $9 million. But in the decade following the 1955 merger, aggregate sales of $595 million produced an aggregate loss for Berkshire Hathaway of $10 million. By 1964, the operation had been reduced to 2 mills and net worth had shrunk to $22 million from $53 million at the time of the merger. So much for single-year snapshots as adequate portrayals of a business. Equity holdings of our insurance companies with a market value of over $5 million on December 31st, 1977 were as follows. We select our marketable equity securities in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be one that we can understand, 2, with favorable long-term prospects, 3, operated by honest and competent people, and 4, available at a very attractive price. We ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stocks we own as an opportunity to acquire even more of a good thing at a better price. Our experience has been that pro rata portions of truly outstanding businesses sometimes sell in the securities markets at very large discount from the prices they would command in negotiated transactions involving entire companies. Consequently, bargains in business ownership, which simply are not available directly through corporate acquisition, can be obtained indirectly through stock ownership. When prices are appropriate, we are willing to take very large positions in selected companies, not with any intention of taking control and not foreseeing sellout or merger, but with the expectation that excellent business results by corporations will translate over the long term into correspondingly excellent market value and dividend results for owners, minority as well as majority. Such investments initially may have negligible impact on our operating earnings. For example, we invested $10.9 million in Capital Cities Communications during 1977. Earnings attributable to the shares we purchased totaled about $1.3 million last year. But only the cash dividend, which currently provides $40,000 annually, is reflected in our operating earnings figure. Capital Cities possesses both extraordinary properties and extraordinary management, and these management skills extend equally to operations and employment of corporate capital. To purchase directly properties such as Capital Cities owns would cost in the area of twice our cost of purchase via the stock market, and direct ownership would offer no important advantages to us. While control would give us the opportunity and the responsibility to manage operations and corporate resources, we would not be able to provide management in either of those respects equal to that now in place. In effect, we can obtain a better management result through non-control than control. This is an unorthodox view, but one we believe to be sound. Banking. In 1977, the Illinois National Bank continued to achieve a rate of earnings on assets about 3 times that of most large banks. As usual, this record was achieved while the bank paid maximum rates to savers and maintained an asset position combining low risk and exceptional liquidity. Gene Abegg formed the bank in 1931 with $250,000. In its first full year of operation, earnings amounted to $8,782. Since that time, no new capital has been contributed to the bank. On the contrary, since our purchase in 1969, dividends of $20 million have been paid. Earnings in 1977 amounted to $3.6 million, more than achieved by many banks 2 or 3 times its size. Late last year, Gene, now 80 and still running a banking operation without peer, asked that a successor be brought in. Accordingly, Peter Jeffrey, formerly president and chief executive officer of American National Bank of Omaha, has joined the Illinois National Bank effective March 1st as president and chief executive officer. Gene continues in good health as chairman. We expect a continued successful operation at Rockford's leading bank, Blue Chip Stamps. We again increased our equity interest in Blue Chip Stamps and owned approximately 36.5% at the end of 1977. Blue Chip had a fine year, earning approximately $12.9 million from operations and, in addition, had realized securities gains of $4.1 million. Both Wesco Financial Corporation, an 80% owned subsidiary of Blue Chip Stamps, managed by Louis Vincenti, and See's Candies, a 99% owned subsidiary, managed by Chuck Huggins, made good progress in 1977. Since See's was purchased by Blue Chip Stamps at the beginning of 1972, pre-tax operating earnings have grown from $4.2 million to $12.6 million with little additional capital investment. See's achieved this record while operating in an industry experiencing practically no unit growth. Shareholders of Berkshire Hathaway Incorporated may obtain the annual report of Blue Chip Stamps by requesting it from Mr. Robert H. Bird, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040. Warren E. Buffett, Chairman, March 14, 1978.